Hello everyone, can you hear me okay? It's all working, lovely jubbly. It's good to be here. I arrived about 20 minutes ago or so. We had quite a few issues with the flights here down from London, so glad to be here via Dundee. But I'm not the only person here with you today. My name's Lyndon, the head of the energy transition. I'll be sort of working with you during the day, but you've got your main speakers with you, Yvonne and Alison from the Northwest European Atlas team. And Stuart Leach, who will be running our first session, which I'll be introducing in just a bit. And then you've got Mark and Teresa, who will be looking at the sort of offshore energy services side of things in the afternoon. Excellent set of speakers, a lot of diversity we're going to have in terms of the content. You'll have opportunities to ask questions throughout the day. What we will try and do is have the presentations and then questions afterwards. So try and keep it like that unless there's something absolutely burning. And then, if you skip to the next slide, please. That's me. We will be doing a panel also towards the end of the day, for the last hour, where we've got Paul, Nick, and Mark, who will be sharing their views, essentially what we've been talking about today, but some of the other key questions that are in your mind as well. And again, that'll be a really good opportunity for you to ask questions. And that's what really is part of today. It's not just about listening to our views, looking at our lovely slides that we spent hours putting together, but it's to have the discussion and the thought process of what's going on, because there clearly is a lot going on right now. As a bit of a reminder, essentially, you should have hopefully seen this agenda, because that's why you're here. This is what you're excited about. First session is going to be much more focused on calling it the challenges, but also really the opportunities of the UKCS. And that'll be, as I said, run by our kind of Northwest European team. We'll then have a break. Seems pretty quick, but there's always time for coffee to then get ready for session 2, which is then looking at the service sector side of things, really about setting the context and then seeing where the service side of things fits in with that before we go into our panel. I hope everyone here knows us, and this shouldn't really need much of an introduction, so I'll spend very little time on it. If you don't know Westwood, we're a specialist market intelligence provider. We have our specialisms, sort of ENA Global, EMP Northwest Europe, New Energies Northwest Europe, going to global, but also specifically offshore wind is global. And then you've got the services side of things, both for offshore and onshore. There are folks around the room, as Gareth said, we've got the little blue line on there. These are people you can talk to about any of this stuff, but also there's a whole setup at the back there for you to go and spend some time on, either during the breaks or afterwards, to learn a little bit more about that. These are our specialisms. I won't go through really the next few slides. You'll be sent that with the pack, but it's essentially a bit of a replica, a bit more depth around the different areas. Important slide. I'm not expecting you to read it, but just to say everything that is said within this room obviously comes with a little disclaimer attached to it. Now, I wanted to just say a couple of words before we start our first session, and I hand it over to a few folks. There's been a lot of things that have been happening, both in the UK and I guess globally in the energy industry, that have kind of disrupted the energy sector. And the question I often get asked is, how much has that either sped up or slowed down the energy transition? So I thought I'd just pause for a second and ask the audience as a starting point, get a bit of a litmus test going as to whether things like COVID, inflation, other political changes, a stuttering Chinese economy, those sorts of things, what have they done? Have they sped up or have they slowed down the energy transition? So let's go with sped up first. Can you please put your hand up? And you have to vote, by the way, otherwise you can't take part in today. Do you think what's been happening over the last couple of years has sped up the energy transition? I'm even going to ask the second part, because I'm assuming it's a minority that we've got here. So that's interesting. So the litmus test of the room is saying that the energy transition has slowed down. It'd be interesting to get into the debate as to why that might be. Now, certainly, what we have seen is, of course, that there has been no peak oil demand. In fact, we're expecting to have record emissions this year. And obviously the slightly odd weather that we're having at the moment is a sign of that. But essentially, you know, emissions are going to peak even further. Oil demand is going to grow. I think the IEA World Oil Outlook is saying there's going to be another 2 million barrels or so of demand added just this year alone. So it does look like a year that's very rosy and a few years maybe going forward for the oil industry. But at the same time, investment in clean energy technologies has continued to grow even faster, right? We're not talking about a few billion more, we're talking about hundreds of billions more going into the clean tech sector. So it is also worth going into this process, into the idea of what's happening around us, whether we think things are going faster or slow, with the mindset of understanding that we look at it in our bubble and things may look really rosy, but at the same time, a lot of other things are happening around us. And so the short-term picture often looks very strong. The question we have to ask ourselves, what does the long-term picture now look like? In fact, if you look at it, it often looks like there's more risk rather than less because of the investment that's going on elsewhere. And that doesn't actually make it easy for companies, let alone countries. You know, getting to net zero, if you're on the net zero journey, is particularly complicated. And what's become more complicated, and this is why it's particularly relevant, I guess, for the UK, is if we moved from just saying we need to get to a sustainable net zero energy system to one that is both secure and affordable and a just transition as well. That triangle, that trilemma has really come back into the fore over the last few years. The issue that we have today, of course, is that energy policy is being politicized, right? It's more about votes rather than rational, factual behavior. So hopefully what you can see as part of today is as much as the fact of what's going on, and the debate we want to have this afternoon should also be based in fact as well, and that's why we've got some of those esteemed guests with us here today to have that. But the UK, the reality is, of course, the UK is blessed with many natural resources. It's blessed both with fossil resource and with renewable resource. We've got fantastic opportunities. But right now, if you look at, for example, the offshore wind industry, it is clearly looking like it is not working very well on that side of things. At the same time, you hear the grumbles on the fossil side as well. So actually, if you look at it on both sides, things are not quite working out as we would hope across the energy sector. But everyone in this room does know that the oil and gas industry is a part of that transition, whichever way that might be. And so have a bit of a lens as we go into this around fact and rational. That's what we're trying to present today. And I'll let the analysts do their job and present those facts over the next couple of hours. Yvonne, over to you.
Thanks, David, and thanks for being here. And start my watch so that I don't overrun my time scale. As David said, long-term supply-demand forecasts the hinge on the transition to affordable, sustainable, and secure energy sources. We all know that. But ultimately, supply will follow the demand trend. And while there is demand, there will be businesses endeavouring to meet that supply. Higher commodity prices, I haven't changed this. Great start. Higher commodity prices are driving activity levels globally in the majority of regions around the world. It's particularly following periods of underinvestment. Drilling is on the increase, developments in LNG projects are progressing, and new exploration hotspots are emerging. Now, investment in renewable energy sources is also ramping up. For example, China has overtaken the UK as the largest wind power generator, and this is actually in parallel to its own increasing domestic oil and gas production. Now, this is busy, but it just follows on from what David said. In the UK, we're facing challenges. Against the backdrop of increasing global activity, we in the UK are facing significant challenges with the fiscal stability, political uncertainty, in addition to the media-hungry opposition groups. Energy Profits Levy, the EPL, has impacted near-term investment in oil and gas projects. The activity levels are considerably depleted compared to what our expectations were early in 2022. And although the UK government has stated its commitment and support for the oil and gas sector, the commodity price floor is not expected to reduce the 75% current tax burden by the end of Q1 2028. And even with the associated investment allowances, most companies are unsurprisingly hesitant to commit capex. There is also a looming general election and the possibility of a Labour government where there is even greater uncertainty in terms of its position for future licensing, E&A activity, new developments, and of course the fiscal terms. Conversely, the wind industry is in the ascendancy. It will be key to delivering the energy transition in the UK. And as we can see from the chart here, there it is. This is showing an exponential increase. Sorry, the pointer's not working, which is going to kill me today with lots of charts. But there is an exponential increase in the annual expected expenditure in wind. But as per that bottom headline, there have been challenges in the wind industry. The impact of inflation on costs is affecting timeline and bureaucracy, of course. And delivery of those timeframes, for execution, will, of course, be crucial to delivering the targets. Now, okay, we're missing a slide. That's not so good. Excuse with me. There it is. It's back to front. Okay, there we go. On the left, a chart you're probably all familiar with, which is showing the projected production and the demand expectations of the UK. Now, regardless of which demand curve we actually end up following, the UK is going to be a net importer. That's a given. So in the centre, we're now starting to look at some of the analysis we have carried out. And this is our current view on hub closures. Now, we define a hub as the processing installation where the fields tie back into. There are currently 74 hubs in operation in the UK or under development, and we do include Rosebank in this number currently because we are expecting that to be sanctioned imminently. Now, based on our economic modelling, which again takes a bottoms-up approach, looking at the fields and the hubs, existing investment plans and costs, etc., we're currently forecasting a 25% reduction in the number of hubs by the end of 2027. By the end of 2033, a decade away, this is reduced to 22, which is quite significant. Now, as we can see, the chart on the far side is looking at the production by those COP segments. The 22 hubs, which is the green, grey, and purple, are actually accounting for 56% of our 2023 production. But the two sort of wedges in the middle, the sort of blue, apologies, it's not terribly clear, and the green, now they account for the 14 hubs in the green slice are 38% of current production, and the 34 hubs, larger number, account for 33%. So it starts to become really a lot clearer as to how many hubs and their production will be dependent on the decisions that could be taken in the next 5-6 years as to what our future production profile could look like. So investment in hubs which are sitting in the blue could bring them through to the green. Conversely, and hopefully not, any decisions to cut current investment plans or production plans, etc., could move it back into the blue. Now, taking another slant on that data set, in Atlas, anybody who's seen our presentations before, we do like to periodically review how the corporate landscape has evolved over time. And we do colour coding just to make it a little bit more visual in terms of the colours and the company types that we're looking at. So here in the top graph in 2033, we've got 42 companies that currently hold equity in producing or under development assets. The top 6 companies, account for 53% of current production. Now, if we fast forward to our current view on 2033, there's not a huge change in the landscape, but there's a huge change in the company numbers. And we've only got 20 companies forecast to hold production in 2033. But in a decade, field ownership is likely to change. We know that. And there's portfolio rationalization ongoing with all companies, all E&P companies. There are potential buyers out there who are looking to get into and build positions in the UK. And getting assets into the right hands has and is, as always, as important to unlocking future value. And we do know that companies still have an interest in the future of the basin. There was significant appetite for the 33rd licensing round, which is due to be awarded hopefully sometime in September. There were 75 applicants applying for acreage in that round. So that was the who. Now let's look at the what. The centre map shows the 22 hubs that we forecast will be producing in 2033. The picture is pretty sparse, especially when you're considering potential future tieback opportunities. So on the right, and as we know, plans can change, we've included on the map on the right the hubs which have estimated COP years between 2030 and 2032. Another 21 hubs come into the picture. And that gives you an idea of the potential, and it also makes it more attractive when we're considering potential tieback opportunities. So the kind of key message is if we want to reduce future imports during the energy transition, we need to maintain the hub infrastructure as much as possible to maximise the production, obviously, and retain that infrastructure for future development, development opportunities from discoveries, and potentially future prospects. Now, let's start by looking at maybe the negative. Although investment in production is mired with uncertainty, a bit like death, decommissioning is inevitable. And it does present a huge opportunity for the UK. A different opportunity, but an opportunity. We're currently forecasting about $49 billion spent in abandonment in the UK, half of which is in the next 10 years, based on our current assumptions. So chart 1 is just showing the abandonment spend by year with the cumulative spend on the right-hand axis. And this is based on our current estimates for time frame for cessation of fields and hubs. As you can see, there's a gradual increase to the end of the decade and to the end of the 2020s, and then we have an uptick, which aligns with all of these hubs potentially ceasing. On the right-hand chart, we're showing a view of the top 10 operators by gross ABEX. Now, some decommissioning activities and spending plans are fairly firm. TACA, for example, is not expected to change its position as the sort of highest, the operator managing the highest ABEX. But forecasting spend on the left is likely to change as decom activity is particularly reliant on a number of factors. It really hinges on the COP years, and these can be subject to change in their own right. It can be subject to the timeframes between different E&P companies, between ceasing production and the decommissioning activities actually starting, equipment availability in the future, rigs, heavy lift vessel, people. And then, as we've seen with CapEx, E&P companies, they change their minds. So let's move on to try and look at that picture, but on a per well basis. Now, this is a little bit more difficult, but 45% of decommissioning spend is equated to P&A activities. So the current market, based on our calculations, is about 22 billion, with a huge number of wells. The chart is actually showing the number of development wells associated with producing fields and then plotted according to when those fields cease production, based on our current economic estimates. And then we further split it between the S&S area wells, subsea and platform, just to try and differentiate a little bit. Now, between 2024 and 2033, there is this steep increase in the number of wells, and this aligns with what we've shown for hub closures. But of course, there is a lag between COP and P&A activities, and that is probably going to be more the case in the future, building even further into the uncertainties. There's still 420 wells, which is this first bars that you can see there, which are still pending abandonment, but they're associated with fields which ceased before 2022. It takes time. We understand what's required in decom. We're just not entirely sure on the when. And that is a particular challenge for the supply chain going forward, especially with the backdrop of global increased activity. So now moving on to look at the development opportunities. Now, here on the left, the bar chart, we have charted the total number of discoveries which we hold in our database and split by our classifications. So these are near-term developments where we're fairly firm that they'll progress, commercial discoveries, and both these account for about 1.6 billion barrels of oil equivalent, so we're still a prize. Then we have the technical discoveries split by unlicensed, licensed, and in pink, what we can show here is the acreage for the 33rd round. And that's particularly interesting, because as I mentioned, there were 75 companies interested, and we've looked at the acreage which has been applied for, and it looks like there's about 84 discoveries within that acreage set that's been applied for in that round. So it's quite an exciting time for the future, hopefully. On the right is a slightly different view of the discoveries, fitted into those discoveries lying 30 kilometres from an existing hub. So this is based on current infrastructure, of course. So looking at Central North Sea, down at the bottom here with the grey bar chart, it appears to offer the greatest prize for opportunities. So we've got 2.3 billion barrels of oil equivalent within the CNS, but these are all relatively small, and the vast majority have lain stranded for years. We've delved into this a little bit further, and we actually identified 780 million barrels of oil equivalent in 50 discoveries, which are between the 10 and 25 million barrel of oil equivalent mark. They're not HPHT, but have failed to move forward. Now, the reasons for this are many, but the three key reasons are technical, economic, or access to finance challenges. It's been the case for years, unfortunately, is still present. An example of that is Leverett. It's being appraised at the moment. Any guesses when it was actually discovered, people? Ali should know. 1975, when ABBA were at their peak. Up in the NNS, it's a similar story. Here's a sector we now have line of sight on a number of hub closures within the next 3 to 5 years. However, there are opportunities here for heavy oil, and if companies can unlock the economics for the likes of Bressay, Bentley, even Pilot, there could be opportunities, and it could still keep that sector going. Moving to the SNS region, there's been a bit of a renaissance for the area in the last few years, thanks to the gas price and to the role of gas in the energy transition. Pensacola has brought some exploration success, and M&A activity is boosting the appetite for progression of E&A and for some developments. And finally, if we move to the west of Shetlands, the resource distribution here is different from the other regions. Here, the undeveloped discoveries are larger and more material. Unlocking those large material discoveries, however, likely hinges on electrification. The likes of Clare, South, maybe even a Foinaven redevelopment really need electrification in that west of Shetland region, and let's be fair, Rosebank and Campbell could kind of do with electrification as well. So that's it from me. I'm going to hand over to my colleague Stuart Leach, who is going to start looking at the opportunities which could be available through electrification.
Yeah, thanks, Yvonne. So we said opportunities in electrification. But to understand that, we first have to understand the motivation for doing electrification. So in the UK, we can see a reduction in absolute emissions year on year, going from 13 million tonnes in 2018 to 9.7 million tonnes in 2022. This has been driven by decarbonisation of some assets, as well as the closure of some older, poorer performing facilities. However, as we extinguish those low capex solutions for decarbonisation, it's going to cost more to maintain that downward trend. So the North Sea Transition Deal is targeting a 50% reduction by 2030 against the 2018 baseline, and net zero by 2050 for the basin. Now, with roughly 70% of your offshore emissions coming from fuel consumption for power, electrification is critical in meeting that 2050 target. However, electrification is not a cheap solution, and therefore hub longevity is going to play a factor in which hubs are electrified and which ones are a viable solution. So, reusing a visual you've seen earlier, in the top right-hand side here, we show hub production by hub closures. I've just simplified the color coding. And in the bottom left here, we've got a bubble plot showing the individual hub emissions performance, split by blue, black or green, depending on when the hub is due to cease. Further you are to the right-hand side, the poorer your emissions performance. So stepping forward post-2033, yes, the closure of those hubs in black will help reduce the emissions in the basin, but those ones in green are still running, and those are the ones where electrification has potential. Now, there's a number of electrification initiatives underway, and Westwood wanted to understand what electrification could mean for some of these hubs. So in the next couple of slides, I'm going to run you through a case study we recently carried out to understand the potential returns for electrification. So we selected the west of Shetland and central North Sea hubs shown here, as they have the production longevity. And under our base case assumption, we modeled two scenarios. So the first, on the left-hand side here, looks at the reduction in emissions through electrification only. So effectively, how the savings on emissions charges would impact the cessation of production and how much pre-tax cash flow could be added. And in this scenario, we see the results hardly change. Hub lives extended by only 1 or 2 years, and with little change in post-tax cash flow, indicating that the cost of carbon alone is not sufficient to justify the cost of electrification. Next, scenario 2, we took that a bit further, and we looked at an emissions reduction plus a 50% OPEX reduction. So this is assuming your savings through maintenance reduction, fuel costs, more gas available for export. And here we start to see the results are a bit better. You get an extra couple of years on production added and a greater level of pre-tax cash flow generated. So taking that scenario 2, we see that with the OPEX reduction, the economic case for electrification starts to become tangible. Shared infrastructure could also further decrease the capex associated with these electrification projects. And we already know a number of operators and partners of different hubs that are working together to evaluate these possibilities. There are, of course, challenges, both technical and commercial, as well as being able to deliver these projects before the end of the decade, which, let's be honest, is not actually that far away. So collaboration, and quickly, is required to ensure that these electrification projects can actually become a reality. Now, one thing I have not yet mentioned, and we didn't model in this case, is the impact of the EPL, or more specifically, the 80% investment allowance for capex spent on decarbonisation of oil and gas hubs. The tax relief should remain in place until 2028, or until we reach that price floor. So with a tax relief of £1.09 on every pound spent, why are companies not rushing to cash in on this opportunity? And it could well be those political and financial uncertainties Yvonne touched on in the beginning that's causing that concern. I'm going to pass back over to Ali. I'm going to have a look at the opportunities in E&A. Thank you.
Thank you very much, Stuart. I'm now going to look at the E&A side of the business. Okay, oil and gas will continue to be a part of the UK's energy mix for the foreseeable future. So where does exploration fit into the mix of future opportunities? To understand this, we need to look at recent historical activity and performance and see what we can learn. Since 2013, including the first half of this year, a total of 117 exploration wells have been drilled. However, as you can see from the graphs, activity and performance has been in general decline. The top left-hand chart shows the number of wells drilled per year, colour-coded by whether they were commercial discoveries, non-commercial or dry holes, and with a line showing commercial and technical success rates. A decline in exploration activity is very clear. In terms of performance, the average commercial success rate for the decade to 2022 was 20%, and only dropped below this in 2013 and 2019. And although the commercial success rate looks like it's improved over the last few years, only 4 or 5 wells have completed each year since 2019, and the statistics are therefore not fully representative. The last column is for H1 2023, and already to date 5 wells have completed, 3 are currently drilling, and there are a further 3 wells planned for the year. Is the downward activity trend being reversed? We've seen 2 commercial discoveries, 2 non-commercial discoveries in the first half of this year, giving a commercial success rate of 40%. Pensacola at 99 million barrels and Olav at about 30 million barrels equivalent have completed as commercial discoveries, with North Egg and Ben Riach as non-commercial. There are still 3 wells operating, of which Alwyn East is understood to have made a discovery, and the K2 well has been announced as hydrocarbon bearing. In the middle chart, the bars represent resource volumes discovered each year. A total of about 480 million barrels equivalent have been discovered since 2013 and has averaged 25 million barrels per year. 2023, however, is looking to be positive, with 120 million barrels already discovered and hopefully more to be announced. In the last decade, the UK has failed to add any large discoveries, with none greater than 40 million barrels until this year. Appraisal wells on Glendronach, Glengorm and Isabella have all downgraded to less than 40 million barrels equivalent each. The Pensacola discovery this year has bucked the trend. It was originally quoted as finding about 50 million barrels, but resources were recently updated to 99 million barrels equivalent. However, the discovery does need to be appraised, and hopefully this will be next year. Looking at the right-hand chart, reserves replacement from exploration has been low throughout the decade, ranging from 2 to 15%, falling a long way short of replacing production. So far this year, though, reserve replacement is already at 25% of the forecast full-year production. Could 2023 be a positive change in the trend for exploration activity and performance on the UKCS? 77, which is about 69% of the 117 wells that have been drilled since 2013 to H1 2023 have been ILX wells. That's infrastructure-led exploration. The remainder are either high-impact, frontier, or non-ILX. The bubble chart shows the split of well types, but note that high-impact and frontier wells can also be ILX wells. ILX drilling in the UKCS has historically been high at over 60% every year, except for 2019 when a relatively large number of wells were drilled. 7 of the 15 were high-impact or frontier, and 6 were classed as non-ILX wells. ILX wells discovered 73% of the total volume during the period. The majority of the non-ILX volume is from Pensacola, which, as I've already said, needs to be appraised. Westwood believes that ILX exploration will remain high compared to high-impact and non-ILX wells. There is still need to continue to explore, discover resources, and then develop them with low-carbon solutions. And this is our near-term pipeline of planned wells. Most are in the central North Sea and the southern North Sea. In the chart on the right, the wells are shown in basin order, plotted against pre-drill resources. 3 are currently operating, those are the light blue bars, with a further 3 wells to spud this year. That includes Devil Hole Horse, Greenwell, and Jocelyn South. The wells coloured in red are those with a high chance of drilling in 2024, based on our intelligence. Of the wells shown, all are ILX, except for Devil's Hole Horse and Dabanet, and further wells are likely to be added. So what's the prospectivity of the basins? Let's look at the yet to find. The chart on the left is taken from the NSTA UK Oil and Gas Resources document, published in early 2022. The coloured bars and lines show ranges of prospective resources for each basin. The NSTA used various cut-offs to arrive at a total mean prospective resource of 4 billion barrels equivalent in 500 features, which are prospects or leads. As can be seen, most of the volume is in the central North Sea. The NSTA also hold additional prospective resources of about 11.2 billion barrels equivalent on a play level. The middle chart shows Westwood's unrisked prospective resources split by basin. Using different methodology and cut-offs to the NSTA, Westwood holds a total of about 90 billion barrels equivalent in resources, a large proportion of this being in the central North Sea. The right-hand chart shows Westwood's risked resources using historic exploration statistics to guide the chance of success of a prospect based on the age of the play and the basin being drilled. This gives a risked resource of about 12 billion barrels equivalent. However, since a lot of the prospects are unlicensed or in areas outside of any hub catchment area, they will struggle to get drilled. Over 20% of the unrisked resources lie in the west of Britain, where infrastructure is lacking. So we have looked at the resources that lie within the proximity of hubs on the next slide. So 35 billion barrels equivalent of prospective resources lie within 30 kilometres of a hub. The top left chart shows the volume by basin, mostly lies in the central North Sea. The graph also shows the percentage of prospects on currently licensed blocks. But of course, once the 33rd round awards are made, this percentage will increase. The bottom left pie chart shows a split by basin for the 4.7 billion barrels equivalent risk resources. Again, the central North Sea dominates. The chart on the right shows prospectivity within 30 kilometres of every operational hub. Where prospects are located within the catchment of more than one hub, the prospect is included in the prospectivity of each hub. This, of course, leads to double dipping, such that the unrisked volumes for each prospect can be assigned to a number of hubs, but the process gives an idea of resources in the proximity to each of the hubs. The hubs themselves are colour-coded with COP year, the green-coloured ones having the longest field life. This would allow for more time for prospects to be drilled and potentially extend the field life of the hubs. And although the hubs to the left have the highest prospectivity, the chart does not show which hubs are the most suitable for tieback. So what I'm trying to say is any partners that are in hubs to the left of the chart should not get too excited. So what opportunities could the latest 33rd licensing round bring, for which we're still awaiting results? The government published assessment documents in July and August relating to the round, and the documents list the 258 blocks that have been applied for and the 152 blocks that require further screening. Potential work programmes have also been listed for these blocks, including 22 that have a straight to second term bid, which means they have to submit an FTP within a specified time frame or drop the licence. Although awards were originally expected in Q2, the consultation on the assessment of blocks has been extended 2 weeks to the 15th of September, so it's likely that the the announcement will be postponed significantly because of this. You'll see from the maps that the blocks that have been applied for, which are in pink, include a substantial number in the southern North Sea, as would be expected with the current focus on gas resources. Perhaps surprisingly, there are a large number in the west of Shetlands. These are likely to contain relatively high-risk prospects with mainly gas as the expected phase and have potential offtake challenges unless a new hub can be created. There is relatively fewer applications in relationship to the size of the basins in the northern North Sea, central North Sea and mid-North Sea High, and only 2 in the East Irish Sea. Westwood has identified 84 undeveloped discoveries on applied for acreage with 1.45 billion barrels equivalent in technical resources. The majority of the discoveries and volumes, which is 74%, are located in the central North Sea or southern North Sea. Gas and gas condensate discoveries account for 61% of the discoveries. In addition, Westwood holds 366 prospects with unrisked resources of about 14.6 billion barrels equivalent. At the opening of the round, gas opportunities were the priority and 4 key cluster areas were identified by the NSTA in the southern North Sea. So I'm going to zoom into that basin now. So the 4 cluster areas are outlined in black and the applied for blocks are in pink, showing that most blocks were applied for. The only exception is the northwest block in cluster 4 containing the Harmonia discovery. Cluster 3 is the only cluster area that has not been applied for with a straight to second term bid. There have been articles written in the press about how recent licensing rounds have not delivered in terms of wells being drilled and discoveries being made, and whether future licensing rounds would have an impact on North Sea activity. While discovered volumes are small in comparison to produced volumes, Westwood analysis suggests that exploration results are being made on more recently awarded acreage. The left-hand chart shows the exploration activity in the last decade for wells drilled on acreage from each licence round. As would be expected, most wells are on more recent licences, as the earlier ones are likely to have been reduced to field outlines only, with no remaining exploration potential apart from deeper targets or step-out prospects. The right-hand chart shows the associated discovered commercial resources. So whilst it is true that the volumes being discovered are very small compared to the heyday of exploration of the North Sea, discoveries are still being made, especially on acreage awarded since 2012. Encouragingly, there are wells planned for the rest of 2023 and into 2024 that Westwood have sight of, and hopefully there'll be additional well programmes drilled off the back of the 33rd round awards. But will they get drilled in time to make use of the infrastructure before it disappears? So we drill exploration wells and we make commercial discoveries. How long is it going to take to get the hydrocarbons on stream? And referencing back to Yvonne's presentation, will the tieback hubs still be available? The chart shows the average time from discovery to production over the years, with the blue bars representing discoveries larger than 50 million barrels and the darker ones being less than that. The numbers to the right of the bars represent the number of discoveries in each category. Since 2011, 14 commercial discoveries have been brought on stream or are under development. Six of these were progressed to production in 3 years or less, and either had common ownership with the host infrastructure or have been small tiebacks. As discoveries get smaller due to the high maturity of much of the UKCS and potentially more difficult to develop due to geological or engineering complexities, reliance on nearby infrastructure is key. And just to finish off for me, there is quite a lot of competition for the seabed, no more so than in the southern North Sea as shown on the map. Exploration, appraisal, development drilling, decommissioning operations, these have all coexisted with fishing and offshore wind farms for many years. However, the extent of wind farms is growing, and there are now carbon storage licenses which will require seismic acquisition, periodical monitoring and drilling activity, and new pipelines will also be needed for some projects. So on that note, I'll hand over to Stuart to discuss the carbon storage round.
Me again. Right. Thanks, Ali. As mentioned, I'm going to look at some of the opportunities for CCS in the UK. So I'm going to touch on how much carbon storage we might need. I'm going to review the recent carbon storage licensing round. And finally, we're going to look at what's next and some of the uncertainties and challenges that still remain in leveraging this opportunity. So with legally binding net zero targets and large industrial heartlands, CCS is considered critical in achieving net zero in the UK. The UK is targeting 2 clusters online by the middle of the decade and 2 more by 2030. It's also targeting 20 to 30 million tonnes per annum of CO2 captured and stored by 2030. Now, these projects are only the beginning of the CCS industry. So under the various pathways to net zero, it's estimated we'll need 50 million tonnes of CO2 stored by 2035, and anything between 75 and 180 million tonnes of CO2 stored annually by 2050. And all of this is going to need to be stored in the North Sea, and each storage site is going to require a license. So, turn my page would help. UK carbon storage licensing round was announced last year. So, prior to the round, there were 7 carbon storage licenses that have been awarded over the last 10 years, of which 6 are active. And these are shown in yellow on the map. As part of the licensing round, 13 areas were offered in the pre-round nominations, and these are shown in the pink outlines. So following the closure of the application window in September last year, the NSDA announced they'd received 26 bids from 19 companies. So interest in CCS was high. In May, just recently, the NSDA announced the 20 licenses that had been awarded to 12 companies, and a 21st license was announced in June in the southern North Sea. These are currently going through the various negotiation stages with the companies, and we expect to hear announcements on who got what soon. So these are shown in the dark blue outlines in the map. Now, I should highlight at this point that the license outlines are based on what was offered by the NSDA in May, and although it's unlikely, there is a chance that those boundary lines may have changed during the negotiation stages. So we had hoped to share with you who'd got what, but as we said, the negotiations are still ongoing. But some companies have come out and publicly stated what they got, and we've got a fairly good idea of what the other areas were. So I'm going to have a look at who those companies might be, and also what their motivations might have been for bidding. So looking at each of the individual licenses offered, those shown in green are where the licensees have announced they were successful. A license shown in grey is Westwood's opinion of the potential licensees based on ownership of existing carbon storage licenses, proximity to hydrocarbon fields or existing infrastructure. In the East Irish Sea, Spirit Energy announced it was offered EIS Area 1. So Spirit own 100% equity in the Morecambe South and Morecambe North gas fields, which are the primary storage targets due to cease production by 2030. In the northern North Sea, EnQuest has confirmed it's been offered 4 licenses. So EnQuest has plans to develop an associated carbon storage project at the Sullom Voe terminal. into Shetland. So the company plans to have liquefied CO2 transported up to the Sullom Voe and then eventually shipped to the storage site using the East of Shetland pipeline infrastructure. Given remoteness of the storage sites, access to CO2 here could be challenging. And in the central North Sea, there's 2 licenses offered. Both are expected to be offered to one or more of the Acorn partners, either Storegga, Harbour, Shell, or NSMP, as an extension to the Acorn project. Now, continuing south into the southern North Sea, we understand this was a hotly contested area. So not only due to the high-quality storage reservoirs, but also the proximity to CO2. So the region's close to the Teesside and Humber industrial clusters in the UK. You've also got the large emitters in London and the southeast. Then you also have access to CO2 from European countries bordering the North Sea. Now, I'm not going to run you through every license, but we're just going to pick out a few of the interesting ones. So SNS Area 1 in the top left there, we expect to be offered to BP or Equinor as an extension of their existing carbon storage licenses 1, 6, and 7, which form part of the East Coast cluster. Up in the top right, Neptune Energy have confirmed they were offered 3 licenses surrounding the Cygnus field. So it's not yet clear if Neptune will partner on anyone with those licenses. It's worth bearing in mind that Neptune has ambitions to store more CO2 than their Scope 1, 2, and 3 emissions by 2030. So it's no surprise their involvement in the CS license round. Elsewhere in the southern North Sea, there's a number of licenses that have been offered surrounding the existing license CS5. So this license is operated by Harbour Energy as part of the Viking CCS project that's being developed by Harbour and BP. Consequently, those licenses surrounding CS005 are expected to be offered to those parties. Harbour announced last week that alongside BP, they'd been awarded 2 licenses adjacent to CS005. It's still to be confirmed exactly which ones, but initial thoughts are it's SNS 8 and 4.1. SNS Area 3 on the left-hand side here is a bit of an unknown. So the entire area was offered as a single license and is considered as a bit of a land grab. There's no underlying hydrocarbon fields, so it'll be interesting to see who actually went for this. And elsewhere, Perenco and Carbon Catalyst have announced they've been offered 3 licenses. So Perenco owns and operates significant gas infrastructure in the Humberside area, including the Dimmington terminal, and plans to evaluate possibility to reuse existing gas infrastructure for these projects. So where does that leave us? We can see the range of companies who's currently active or want to be active in carbon storage in the UK. And looking at the profile, it's pretty much the usual players. There's a couple of pure play CCS companies that have entered, like Carbon Catalyst. And the motivations for companies stepping into this will be slightly different. As we said, some will be looking to expand or de-risk existing CCS projects, adding an additional storage site. It's evident Acorn, Viking, and East Coast cluster projects have been looking at that. Some companies will be motivated by the potential to defer decommissioning costs and enable infrastructure reuse. So take Spirit Energy, 100% ownership, and Morecambe or Perenco looking to reuse their existing infrastructure in the SNS. ESG targets could be motivation, as we mentioned, Neptune with their Scope 1, 2, and 3 emissions targets. And finally, there's the license to operate. If you remember that plot from earlier that Yvonne showed you and who would still be operating in the North Sea come 2033, a lot of those companies have appeared in the CCS space as well. So what's next for CCS and what's going to happen in the short term? So all those storage sites need to be appraised. So the storage sites for the original 6 has been ongoing for a number of years, while those new 21 licenses will just be starting. Work programs are going to include risk assessment, seismic acquisition or reprocessing, site characterization, and some include firm and contingent wells. There's a chance that not all of these will be developed into fully fledged CCS projects. Some of these sites may be dropped if they're deemed unsuitable during the appraisal stage. Construction of the full value chain actually needs to begin. So while the focus has been on offshore pipelines and subsea infrastructure, let's not forget that you actually have to capture the CO2 in the first place. There's not a single capture site. There's not a single carbon capture project that's taken FID yet. And of the three out of the four clusters, so HyNet, East Coast Cluster, and Acorn, all have a greenfield blue hydrogen project at their core that also needs to get built. Previous reuse of infrastructure, particularly offshore pipelines, needs to actually be validated for their suitability. And finally, the drilling operations can commence. So we know of one outstanding rig tender with Eni, with the HyNet project. And Teresa's going to run through the rig outlook for CCS later in more detail. But CCS is not without its challenges. There's some uncertainties around the support mechanisms. We know the track 1 and 2 clusters now, but how much money is actually going to be allocated to Track 2, what funding will be available beyond Track 2. We'd like to think that eventually the CCS market makes economic sense, but in the meantime, government support is going to need to actually make these projects economical. Project timing is going to be challenging, and competition for CO2 will be a factor. So while there's no shortage of CO2 in the UK and Europe, in the short to medium term, actually access to that CO2 and transporting it to the site could become a bottleneck. Looking at the carbon storage licenses, our analysis suggests that there's companies that own the hydrocarbon license that's still operating in that region, which is a different company to the licensee holder for carbon storage. So how that co-location will be managed between the two companies is still a bit of an unknown. While infrastructure reuse, as I said, an opportunity but hugely challenging. So we've got to remember we're trying to reuse equipment and pipelines for an environment and a fluid they were never originally designed for. But despite all these challenges, interest in CCS is high, and there is undoubtedly a huge opportunity here in the future. So to wrap it up, where does that leave us? Hopefully the message you've taken away from us today is that despite uncertainty and ever-changing political priorities, the UKCS still presents a number of opportunities. There's still significant volumes of undeveloped discoveries out there, and interest in oil and gas still remains high. Decommissioning of the North Sea is a busy industry, a number of wells and infrastructure that needs addressing, while the energy transition is in full swing. The offshore wind industry continues to grow and set ambitious wind targets, while by the end of the decade, we should see the development of two new industries, CCS and renewable hydrogen. So that brings a close to our first session. In a later presentation, I said Teresa and Mark will delve a little deeper into the outlook for rigs and the supply chain, after which we've got our wonderful panel session as well. Many thanks for listening. Hopefully we've got time for a couple of questions now. Otherwise, we're milling around all afternoon. Please come and get us, and we'll speak then. Thank you very much. Do we have time? Yes.
We're just supposed to ask one question. No, Colin, not you.
I think apart from Colin, I'm joking. Please go on, Colin. There's a mic just coming your way to start with.
Given the low E&A well count, given the low E&A well count,
I knew it was going to be a difficult question for me.
and given the low level of project sanctions, we've got 4.7 billion up there and 6 billion BOE. Are we going to deliver any significant proportion of that? And if not, what needs to change?
Good question for the panel.
Yeah, yeah, excellent question for that. Well, companies need to have the confidence that they can invest in exploration and development without being slapped, basically. Or am I being controversial again?
What?
Is that controversial? You're better at this, Yvonne, than me, because you've got the whole... Yvonne's got the whole sort of chain, whereas I only think with an exploration head-on. And I want to explore. You're an explorer. We all want to explore, but...
There's probably two ways of looking at it, I guess. Put yourself as CEO of an oil company. Would you put your hand in your pocket today and invest 500 million in a new development? Anybody around the room put their hand in their pocket and invest? Not knowing what's happening in the next 18 months. But we've had discoveries sat there 25 odd years that are waiting to get into the right hands to progress. And it's like, why have these not progressed yet? Now, we've done previous analysis where, it's been a lot of the sort of smaller tiebacks haven't accessed infrastructure because the hosts haven't maybe been open to it, the tariffs haven't been right. That's changed with the evolving landscape. Things have changed over the years. That has opened up a bit more, but we're still not seeing the progression. Access to finance is a huge piece, and access to finance doesn't just happen with the small companies. It happens with the mid-sized companies trying to get, reserves-based loans. But you can only get reserves-based loans if you've got reserves in the first place. You've got a single egg in a basket. How do you bring that forward?
Can I just butt in here?
Yeah.
That's a really good point. So talking about sort of exploration and development, the carbon capture companies that are just setting themselves up, apparently access to funding is not a problem. They can they have money being thrown at them, but we can't get wells for E&A and development. So
it goes back to risk. Yeah. They're willing to invest in some risky projects. They're unfortunately not able to. If I was on a panel today, I'd be asking personally, God, I'm putting my neck out. Personally, not me, not Westwood, I'd be asking the government to think about alternative mechanisms for funding and moving forward some of these developments. I'm not in favour particularly of nationalisation, but why the heck not? Why not do it? Because at the end of the day, the government is going to get tax benefits from it. Contracts for difference. Should we think about something similar for that to move these projects forward? Energy security is needed. We need to do it as green a way as possible. We need it to be in the right hands to do that. So how about the government, HMRC, whoever, thinking about different mechanisms to actually unlock some of this potential that's out there? And it's something that's happened for years. It feels a lot worse at the moment, but it's something that we probably need to do to move things forward. And if anybody from the press is in the room, please don't quote me on that at all.
Don't quote any of us.
I think that horse has bolted somewhat.
Any other questions? That's great.
Oh, this is going to be a difficult one as well.
Come back.
It's all yours.
You can ask him a question back later.
Pay back later.
There's no point in easy questions. I think my question was, I think you might have answered it in the response to Colin, is when you talked about the carbon capture, moving away from exploration, you had some uncertainties and challenges listed on there. One of them was maybe buried in some of the words, but it isn't just funding, it's political will. You've got to feel like the policy is driving behind it, because if it doesn't, it takes you 4 times longer than Norway. And if it takes you 4 times longer than Norway, to your question, that's where your investment's going to go. So
but if you look at Norway, apart from the stuff that's been happening for a long time on the ones that have had the carbon storage for quite, the re-injection part, apart from Northern Lights, none of them have really got that far.
I agree, but their pace of policy from the Norwegian government is extremely positive, whereas I would say ours is very hesitant. And if you can take 6 months doing something that should take 3, or 2 years doing something that should take 6 months, that seems to be the option we're going for. And therefore, and it comes back to Colin's point straight away, is moving back to exploration off the CCS. Look at this licence round. I mean, expected when, delivering when. I mean, we had an announcement a short while ago. I'm getting at the panel, by the way, now, so. So if you want to drift off until 4 o'clock, I'll say the same thing. We recently had an announcement by our government that they would award a licensing round that started in March of last year.
Oh God, it was.
I mean, is that the level we've got to, where we're reporting on a process that started 2 years ago will have an end? We're bogged down.
Yeah. And just to, I will, Bill, drop the mic, pick it up, I'll do another one. Yeah. Norway has, during COVID, Norway changed its tax fiscal terms for the first time in many, many, many years, which was a positive because it drove investment. They unlocked investment and discoveries. The result was that brownfield developments maintained. There was a rush in new field developments that came through. Field development plans that were submitted before the 1st of January 2022 and were sanctioned by the 1st of January 2023 qualified for this tax incentive. I think we've all seen the press headlines, and I cannot remember the number off my head. They have managed to sanction all of the FDPs that were submitted in end of 2022, and some of these were right in December. They have sanctioned them all, and they sanctioned them all before the end of the Parliament breaking up at the end of June. We are only beginning now to sanction Affleck. Talbot was earlier in the year. Teal West was a couple of weeks ago. Just to build on your point.
That's what I'm trying to say.
Yeah.
Okay, maybe just to broaden the discussion a little bit, it's just worth us remembering that if you were to relabel what we're talking about from oil and gas to offshore wind to CCS to hydrogen, exactly the same discussion is happening in every single one of those conferences, right? It is a government's dithering, why are we not having a decision, where's the focus, how are we doing this? There is no hydrogen industry. There is no hydrogen industry. There is pretty much, what, 1 or 2 business models that are sort of defined. The rest of it doesn't exist. CCS, I mean, half of the business models aren't even out there yet at all. So there is a lot that's not going in the right direction in terms of energy policy as a whole, and it's impacting all sectors, which is causing a problem, not just in terms of where do we put our money. So imagine you're essentially a financer trying to figure out where to put your dollar. All the sectors are having that issue right now in the UK, and that's part of the problem. We're essentially having another year of wait before I think we might get a bit more clarity across all parts, and that's a big issue.
I agree, but they are things that have to get going, and everything that has to get going needs momentum. We're talking about existing. We're talking about business as usual. We're talking about doing the things that we've been doing since 1966.
Yeah.
And I would argue, and I will when I'm sitting up there,
Can't wait, can't wait.
Yes.
I'll have nothing left to say, but I would argue that that's a kind of a retrograde step as opposed to a slow forward step.
Okay, look forward to having the discussion.
We better let people have their coffee,
Yeah,
David.
coffee time. Me as
Yeah,
well,
yeah.
actually.
Yeah, I think we are exactly right. Thanks very
Yeah.
much, everyone. A
Thanks,
round of applause to
everybody.
the president.
Thank you. Mark.
Thank you, everyone. I'll just wait for a couple of more people to settle down. So I think one of the things about the first session is it's kind of poked holes into almost every aspect of the industry necessarily, especially when you're looking at exploration, development, the excitement around CCS. And I think I liked where the last question ended, which was looking at other countries in comparison to the UK. So personally, I'd like to start from a global standpoint because it's a global supply chain. But at the same time, we'll try to zone in back into the UK to see how activities are actually panning out, what the challenges have been, and overall where the excitement could come from going forward. So yeah, since the end of the previous downturn, which was the 2013-2014 or 14-15 period, we had a good 2019 from a supply chain standpoint, and you can see there EPC expenditure across the globe was very close to $50 billion US dollars. Obviously, COVID did hit, and we have that V shape with recovery in 2021. We saw similar in 2022 as well. But I'd like to point out some of the challenges that we've seen since 2022. Obviously, at the start of 2022, we were looking at a possible EPC global market of about 80 billion. But then the supply chain challenges start to kick off. The industry was needing to meet the ever-growing liquids and gas demand, which then means the supply chain needed to act fast. However, activities, or I would say decisions that were made in the previous downturn, which more or less a much more streamlined supply chain, meant that not necessarily the supply chain was ready for the storm coming, which then means supply chain cost inflation, which then means some level of uncertainty, and then operators started to react. Operators started to decide to say, this project is relatively too expensive based on pricing right now, so we're going to delay those projects. And we saw that impact in 2022. Some of those major projects, we've highlighted some of those there, even though the likes of Trion offshore Mexico has now been sanctioned. That was previously meant to be in 2022. That was delayed. The North Platte project, which was previously operated by Total Energies, now operated by Shell, is now expected to be sanctioned before the end of this year, but that was delayed in 2022. And the list of projects goes on. Popular Rosebank is also up in the list. But overall, we've seen, and what we currently forecast, is a very, very robust EPC supply chain going forward. So for example, in the first half of this year, we recorded close to 200 subsea tree contract award. I would say that's the highest in any first half since 2012-2013 period. but is that trend meant to continue? So we start to look at all the opportunities, obviously very, very focused on Western Europe or very focused on the supply chain in the UK. And we tend to agree that a lot of those opportunities, especially in the Golden Triangle, when you come down to West Africa, would also be attended to by the supply chain right here in the UK. But overall, we're looking at a very, very robust market going forward, averaging well close to 70 billion in offshore EPC spend when you're looking at the 2024, 2027 period. However, we need to caveat this, that the ultimate boss in the room is going to be oil prices. Right now, the assumption is based on the fact that oil prices will stabilize at least $70 per barrel through the forecast period there, while we've seen oil prices actually more or less fluctuate between $70 and $90 per barrel this year. So let's step it down a little bit into the UK North Sea. You can see North Sea, west of Shetlands, the UK continental shelf. We can see here some of the projects that we've actually highlighted to get sanctioned over the next 12 to 18 months, very much Rosebank. We've seen the creative way in which Equinor has decided to develop this field. I think back in 2012, 2011, 2012, when an FPSO was actually sanctioned for that project, which was later cancelled. And they've now decided to go for an upgrade, which is the Petrojor Qanar unit, which is now in Saudi Arabia to get upgraded, in Dubai, beg your pardon, to get upgraded. We also have an understanding that Technip FMC has been awarded an EPCI contract for the subsea equipment, pending final investment decision or something of sort. But we are quite confident that that project is going to be going forward. However, when you look post-2014, you start to see the market when it comes to EPC award value dwindle significantly. And that is based on the level of uncertainties around certain projects. So some of those projects we've highlighted here are those projects that we're looking at in the near term, but the possibilities that this would get further delayed, especially those that are marked possible, is highly likely, hence shifting that market spend a little bit to the right as well. So yeah, looking specifically into the subsea equipment demand, we've seen a relatively stable 2023 based on some of those subsea trees that have been awarded this year. But then going forward, there's some level of uncertainties. And what do I mean by that? We've actually classified some demand will come from CCS projects. However, as Stuart mentioned earlier, government funding is going to be quite key to majority of those projects going forward at that current timeline. Even though there are specified startup date, the reality is that there could be delays based on how things have actually progressed to date. You can also see the demand from umbilicals more or less peaking in 2024, and that is based on the fact that some of those CS projects would require such lines as well. It is also good to mention here, just like Stuart mentioned earlier, in terms of the reuse and the repurpose of existing facilities. There are some levels of, I would say, uncertainties around that. These are things that have not been done before. Those pipelines were not built for this purpose. However, there are possibilities and ongoing studies around repurposing some of those existing pipelines as well. So need to say, if we follow on from Yvonne's presentation earlier in terms of the level of investment going forward, we see more or less a continuous decline, especially when you look at the pure play oil and gas development. And the opportunities around CCS, even though there was talk around good funding levels for that particular sector, we're not seeing that is going to relatively replace investment levels that will be lost from the traditional oil and gas development. However, it's not all doom and gloom, as Yvonne and Ali has mentioned earlier. There are a lot of relatively potential upsides, looking at some of the stalled projects. As I mentioned before, a project like Rosebank has been stalled for decades, And same here as Campbell, with Ithaca expected to develop that project. At the moment, the plan is looking at a standalone as well as electrification, as previously mentioned. But we are still anticipating once the farm out of the Shell, 30% on the field closes, there might be more, I would say, announcement around a potential development timeline and a much more firmed up development concept as well. Another major project that could be sanctioned and present an upside to the supply chain is the Clear South development in the west of Shetlands. That's operated by BP. Obviously, it's currently looking at the possibility of sanctioning the project next year based on some of the announcements they've made. However, the development plan is not yet firmed up. Previously, a tieback development option was considered, but that was dropped. So potentially, this could be looking at a bridge-linked fixed platform for that particular development as well. But overall, picking back from this morning's presentation or the earlier presentation, there are a lot of satellite projects that could get developed, albeit as single or double subsea well tiebacks, but in some cases could be unmanned standalone platforms as well. But only time will tell around the firm development concept or some of these discoveries that we've highlighted on this slide. So on the flip side, I think there's been talk around the current level of activities, orb closures, and there could be a definite positive spin on this. Obviously, there are negativities around orb closures. There are negativities around what happens to the operational and maintenance supply chain as it relates to that. And as you can see here, we are looking at a possibility of about 21% decline in the fixed platform installed base in the UK continental shelf between 2018 and 2027. We've also highlighted some of the contracts that have been awarded over the last 18 months in terms of platform removals. And that's more or less the positive here in terms of for the supply chain, you start to see the opportunities for engineering, procurement, removal, and disposal. And on the flip side, on the environmental side as well, you start to see the positives around that. So not just all negativity around orb closures or the possibility of leaving recoverable reserves in the ground because there's no nearby orbs. There are other positives that one can pick from this, also from the supply chain in terms of contracting opportunities as well. So just to, not relatively round up, but just to quickly point out that there are opportunities outside the traditional oil and gas development, more or less looking at the Track 1 and Track 2 carbon storage project. And we've looked at some of those projects that could represent contracting opportunities for the subsea sector here. So we've identified those projects in the Track 1, Track 2 phase to come on stream mid this decade and by 2030. And obviously, we've seen some, I would say, relatively high expected demand on certain projects, but I would say that some of these projects are going to be developed in phases. So for example, the Northern Endurance Partnership, we've identified over a 3-phase period could require up to 17 subsea wells, but the first phase is only going to be 5 wells and 1 contingent well as well. And while some of these projects like the ANI INET project is expected to repurpose fixed platforms, surface drilling, as well as some pipelines as well. So there are some technical challenges obviously anticipated in some of the repurposing. So there could be a change in development plan and providing upside, especially for pipeline manufacturing and laying as well. We've also highlighted some projects there on the map that are more or less at a conceptual study phase that could progress or might not progress. And there are upsides based on some of the licensing rounds that Stewart spoke around earlier as well. So that said, I will round off in just saying there are significant pressures from the supply chain, looking at some of those projects that have been delayed based on cost inflation, but we anticipate that we are in more or less in the mid or the start of an upcycle based on the fact that we anticipate oil prices will stabilize above $70 per barrel As you've seen, OPEC Plus will continue to flicker with the switch of supply to ensure that the global supply and oil prices stay within Saudi Arabia's break-even cost, hence elongating the possibility of developing a lot of the global offshore development. Looking at the UKCS, obviously activity starts to dwindle significantly, even if you look at existing reserves, you look at some of the conversation around exploration and appraisal that we've had earlier today, but can some of those projects that have stalled in the last decade come back into the fold based on governmental policies, or most, I would say relatively much more around the stability of oil prices going forward as well. So the landscape for EPC contracting opportunities definitely changed within the UK. However, businesses need to start repositioning themselves, not just to explore opportunities within the UK, but on a global basis. And then you see the decommissioning market as a bright spot as well in the near term. But overall, in terms of CS project, we don't see a huge influx in EPC contracting activity in the near term. However, we anticipate that opportunities right now is going to be around conceptual studies as well as engineering studies based on a lot of those licensing rounds and projects in the pipeline. That said, I will hand over to Teresa. Any questions before I walk off?
If you have any questions, you can just pop your hand up so I can see you. Sorry, mate.
It's all right. No, great.
David.
Oh, David.
In terms of the global supply chain that's out there, from what you're seeing, because you're looking at a global perspective, are you seeing that it's, let's say they're UK focused at the moment, etc. Are they spending more time saying, look, actually the UK isn't my long-term future. I'm not going to look elsewhere in the world because there's just so much activity. I've got choice, essentially, right? I've got so much choice, and I'm going to focus on Brazil as an example, or wherever it might be. Or is still the UK a kind of a core market to a lot of folks? What's the dynamic?
No, I think a lot of the supply chain is already pivoting away from the UK. I wouldn't use the word away from the UK, but they've strategically positioned themselves over the last decade or so. And that is also because of the nuances around opportunities elsewhere. So, for example, you want to go and do business in Brazil, there is that level of local content requirement, especially when it comes to the engineering side of things for those FPSOs, given the fact that we anticipate, a barrage of deployment offshore Latin America as a whole. But I think overall as well, you look at the West African coast. In the past, especially since the 2014 downturn, a lot of projects have been put on hold, but we are beginning to see that come back into the fold, and that represents good engineering opportunity, even supply opportunity for the supply chain in the UK, especially based on proximity as well. So that is more or less an interesting standpoint at this point in time based on the investment that we're seeing there.
And is there a risk that the supply chain may now start to look elsewhere, and therefore there isn't a supply chain in the future? I'm simplifying things, but if you get my drift.
I get what you mean in terms of, is there going to be a brain drain in the supply chain in the UK? I don't see it that way, and I don't think the data currently shows that. I think a lot of the engineering work will still be done, especially for companies that supply chain in the UK that win such contracts. A lot of the fabrication work will be split in some percentage based on local content requirements, based on the project economics as well. But we don't really see that the supply chain is just going to disappear in a sense. It just needs to reposition itself to remain attractive and competitive in the marketplace overall. Thank you.
All right, hopefully, well, and last but hopefully not least is what I was going to say before our panel session comes on. But I'm here to give you a bit of an overview on the rig market. So you know, it's sometimes it's difficult to look at a UK standpoint for the rig market on its own, because obviously we do see some rigs move between those markets of the Netherlands, Norway, Denmark, and the UK. So what I'm going to do is give you a quick global overview, what's going on, show that sort of recovery that's been going on there, and then look more at the Northwest Europe market, but pick out the UK as well and how that's performing against some of those. So globally, the offshore rig market is performing very strongly, and it's clear that the recovery continues to ramp up. Some strong indicators here. Average contract durations for rig contracts are increasing. Jackups are actually up 44%. That's against, 2021 duration. So that's 2023 year to date. So currently standing at 661 days on average. Drill ships increased 50%. Now we're looking at 604 days on average. Semis up 154%, which sounds really pretty amazing. But it's still actually just sitting at 354 days on average, but that's a massive improvement from 2021's 178 days average, which was pretty paltry. There's been an 11% increase in global marketed jackup, semi, and drill ship combined utilization, from 81% to 92%, where we're currently sitting at. Leading edge day rates, so that's only including new mutually agreed rates, so it doesn't include fixed price options, have increased overall 58%. So for jackups, that's 38%, semis 74%, and drill ships 75%. 25 rigs have been removed from the active fleet from January to August 2021, and only 2 have been retired this year in the same period. So really, that's resulted in a 92% decrease in attrition. We've also seen 47 rig reactivations, 13 drill ships, 4 semis, and 30 jackups, plus 18 new builds or stranded rigs have been now delivered during that same period as well. Now, there's been quite a bit reported about this in the news and various outlets. So I'm sure you've all kind of been told or have been involved in this sort of rig exodus that we've been witnessing. So an increasing number of harsh environment rigs have actually been leaving Northwest Europe and heading to other areas for work. So why is this happening? I will talk about it in a bit more detail during the presentation, look at some of those fundamentals a bit more, but unfortunately it does come down to 2 facts. So one, other areas such as West Africa that Mark's been talking about, or a very strong area like the Middle East, are performing very well in terms of offering up long-term deals with high day rates, and also with better follow-on opportunities for their rigs as well. And number 2 is that the North Sea just hasn't been able to provide that same level during the same sort of period. So you can see some of the average duration facts and figures on the tables there that kind of highlight that as well. But you can see in terms of outstanding requirements in Northwest Europe, the average duration is looking a bit healthier thanks to some more significant tenders that are out in Norway currently. However, there is quite a stark difference in the number of available opportunities. All right, so looking first at the jackup market. So this is showing supply, demand, marketed demand, and utilization for jackups specifically. So given a stark, this chart here gives quite a stark picture of how supply has really shrunk over the past years. So overall supply, so that includes your cold stack units, has actually fallen 39% since its peak in October 2017. Really, between 2018 and 2022, marketed supply didn't actually change all that much. We did see a lot of cold stack units scrapped or active units moved elsewhere. And in 2022, there were actually no cold stack rigs available. There were no cold stack rigs left in the market, and that was because utilization, I would say committed utilization, so what we class that as is rigs that are contracted and working now, or rigs that have a contract in the future. So they may be undergoing an SBS or in a shipyard, but they do have work in the future. So that utilisation actually reached 100% for some of the year. And actually, I think round about the this event that we held last year, the same event, I remember speaking to a couple of the drillers in the room who work in the jack-up market, and they were specifically quite, I would say, positive about this market at that point, and that was because we were approaching that 100% mark. However, demand has fallen quite rapidly this year, by 20% in the UK and 16% in the wider Northwest European market. We believe this is a combination of factors, many of which have already been talked about today, so I won't go into them in too much detail. But of course, UK operators have been very vocal that the current fiscal regime and the lack of clarity into the future of the North Sea are big contributors. So because of this fall in demand, we have actually seen a rig recently, or this year, maybe not that recently now, which has no prospects being moved into cold stack. And that is actually right now very uncommon in the sort of global context of things, just because the global jack-up market is very, very tight. And generally, we're seeing rigs coming out rather than being moved into cold stack. So looking a bit closer at award activity then, the light pink on the first chart actually shows UK-specific awards. So quite stark that award activity this year has been very slow. And in addition, average UK contract duration has been falling year on year since 2020. In terms of day rates, when compared with harsh environment units located outside of the region, day rates in the UK and the North Sea in general are continuing to lag a little bit behind. All right, and then in terms of the semi-sub market then, similarly to the jack-up segment, we've also witnessed quite a drop in supply. So total supply decreased 41% since the peak in June 2016 through a combination of attrition and units leaving for work in other regions. Really, between 2021 and today, there hasn't been a massive shift in overall North Sea demand, but we've actually seen a 7-rig increase in demand in the UK since January 2022, but we saw a 6-rig decrease in the Norwegian segment in the same period. So demand has kind of leveled out. Overall, utilisation for semi-subs in the North Sea has remained in the 83 to 90% range this year, but those units located in the UK have actually shown improvement since that low in January 2022 and is now up at around 91%. Award activity for semis is performing well, especially in comparison to the jack-up segment. For the UK, we have seen an increase in awarded days for plug and abandonment work. Actually, 84% of awarded days this year have been for this type of work. 2 of these deals are for a minimum of 3 years each, which has meant a 182% increase in average contract duration year on year for just for the UK year to date. However, as you can see with the orange bars on the right-hand chart, day rates for these UK rigs are significantly lower than those located elsewhere. Now, of course, many of the semis operating in the UK are often mid-water capable, or perhaps older than some of the counterparts that are commanding, the 300, 400,000 a day. And obviously that can be partly attributed to that lower rate. And we do expect to see that if we see, a few more rigs contracted, away on longer term contracts, then utilisation will rise a little more along with the UK day rates. So you might wonder why I've chosen to look at the global overview for outstanding demand instead of just the North Sea. So this is really because there is such a level of uncertainty surrounding outstanding demand at a tender stage in the UK and in the wider North Sea market, that most, if not all, drilling contractors have rigs with availability in the next 12 to 18 months are looking outside of the domicile. And let's be honest, there, from this chart, appears to be quite a bit to choose from. So in terms of outstanding UK semi requirements, the majority of this demand of this outstanding demand is for plug and abandonment operations. But the majority of this doesn't actually start until 2025. And for UK jackups, interestingly, around 1,400 of the 3,000 days are actually for one long-term CCS drilling campaign. And the remainder are for more short-term development pieces of work. So I thought that because decommissioning and CCS is where some of the more substantial UK rig demand is outstanding, or is where it's coming from, and where contracts are actually being awarded, I'd focus a little bit more on these two markets. So this left-hand chart here is showing UK demand by work type. You can see where I've circled that in the pink, that P&A activities actually increased the most during 2017 and 2018. And we actually attribute a lot of that to the fact that day rates were at their trough at that point. And so it made sense for operators to undertake work, since it really that type of work provides very little return. And then this right chart here, which we've seen already from Yvonne, but I thought it was a really good representation of the sort of demand that we could be looking at. It just reiterates that over the coming years, there are a lot of fields planned to end, and with it a significant number of wells that will need to be P&A'd, in addition to those that are already outstanding from pre-2022. Sorry, and as I mentioned, we've already seen an increase in this year for semis being contracted for P&A operations, and additionally of the outstanding tenders and pre-tenders for UK semis. So actually 74% of requirement days is for P&A work. Now, of course, if further rigs leave the region, this will mean an increase in utilisation and likely day rates too. So however, some of the longer-term deals could entice a few rigs out of cold stack, but of course the economics to reactivate a rig must be right, and operators could be put off undertaking these campaigns if day rates are too high. So potentially there is an issue there in the future. And we have seen an indication from a few operators that they are already perhaps spotting this potential issue and have already tendered or awarded deals for P&A campaigns that for work that doesn't actually start until 2024 or 2025. And then we've already heard quite a bit from Stuart and Mark earlier on the CCS outlook for the region, but I wanted to try and cover that from a rig demand perspective. But the emphasis is on try at this point. It's a very difficult thing to do. So we're currently tracking 25 potential Northwest European CCS projects within our RigLogix tool, most of which are in the UK sector. However, I must emphasise that forecasting how many wells, the likely duration of these wells, if new wells are even required, these are all very challenging to do just now because there is so little out in the market. So there has been a fair bit of estimation gone in at this point. Now, these two charts are showing potential minimum demand based on reported and planned projects and targets. But if we were to talk about those in the UK sector that are likely to materialise into actual rig demand over the next 5 years, then the tracked 1 and 2 CCS clusters are a good indicator of that. So from the HyNet Northwest, Viking, Acorn, Northern Endurance Phase 1, we could be looking at over 2,000 days of rig demand. Currently, there is just one operator that we are aware of, and that's Eni, that's out with a tender for a jackup to work of one of these projects, which is their Liverpool Bay project, which is part of the HyNet Northwest. And that is potentially starting next year. But from what we hear from some of the drilling contractors, they're still waiting to hear what the latest is on this project, on this drilling project, because it has the start date has been pushed to the right a bit. Now, from looking at water depths at the majority of these CCS projects in the UK and wider North Sea, it is typically shallow waters. So therefore, we do expect to see mostly jack-up demand in the near term, except from a few projects that we're seeing coming out of Norway. And we are just forecasting a handful of rigs for CCS drilling over the next few years in this region. But there is potential for more. And we would say that would be more likely to come nearer the end of the decade or after the end of the decade, if, and especially so if some of these targets are to be met. All right, so our outlook for the next sort of 18 months then, and really this is just summarising a lot of what I've kind of mentioned before in terms of what we're seeing and what our outlook is. For both the jack-up and semi markets, we are forecasting further lowering in supply through rigs exiting the region for work elsewhere. And to be honest, I think we may actually have been a little bit conservative on this. We could potentially see more leaving. So mostly this is confirmed rigs here that you're looking at. Despite an aging fleet, especially for semis, we don't actually anticipate many, if any, retirements due to drillers seeing potential to reactivate perhaps some of their cold stacked units as the market continues to tighten. However, as you see, the demand outlook is actually fairly flat out to 2024 based on visible projects. Now, I would say that we are expecting to see more of an increase in demand from Norway towards the second half of 2024. But the majority of those sort of larger projects we don't expect until, sort of the third or fourth quarter. However, we still expect to see improved utilization, and that is really due to that lower supply, especially in the semi market, which we anticipate will push rates up higher. And then just some key takeaways. So obviously, globally, the market is looking very strong, and that is why we're seeing more rigs being pulled from the North Sea elsewhere. We're seeing increasing numbers of North Sea assets leave, as I say, and that is mainly due to higher rates elsewhere, higher demand, higher number of follow-on opportunities. There is this continued pressure on the UK rig demand due to several factors, but one that keeps coming up from operators is, of course, the windfall tax. However, P&A and CCS do give us, the outlook there do give us some reason for optimism. But I think timing really is the key here. So operators really need to move quickly on this to help retain the necessary rig capacity before we see more rigs leave, day rates go up, and projects become more costly. And as I said, we expect to see further supply exit the region, and that sort of near-term demand outlook looks a little bit flat. But still, utilization is expected to increase over the next year or two, and of course, that means potentially day rate increases as well. So that is my overview. If anybody has any specific questions, I'm happy to answer them just now.